Manishi Raychaudhuri, CEO of Emmer Capital Partners. Manishi, good morning and welcome to the show. Always a pleasure to speak to you on NDTV Profit. This is Hiral on this side. You know, my question coming to you is, with everything that's happening in and around, now we are talking about a trade deal conversation between India and US that could be happening today. That's the potential. Number two, you have Trump, who's come out and said in overnight, on Truth Social, that any nation who now deals with Iran will see a 25% tariff. I mean, we are at 50% on majority of the items, so I don't think so we could see a major impact of that as well. But how are you seeing all of this play out? Because the moment the conversation happened and when the US ambassador made a statement that tomorrow the conversation or talks are going to progress, we did see that buying interest that did come back to the markets, that short, I mean, you can call it short covering as well. How would you describe this entire setup right now?
Thank you very much for having me. Good morning and a Happy New Year to your viewers. We're living right now in an unprecedented situation as far as geopolitical tensions, the constant news flow is concerned. And, it's somewhat surprising that global financial markets have not really reacted much to this. I mean, the equities are at a record high. I mean, apart from India, that's the situation even in Asia. We have, the Hong Kong market, the Korean market ripping upwards. I mean, Korean Kospi is almost at a 10-year high now. And so is some of the onshore Chinese markets. So, I think the global equity markets are actually looking through this period of tensions and volatility as we are seeing now. And, they're possibly trying to tell us that at some point of time, these trade tensions would be sorted out. And the outcome, if I look at both the Iran tensions and the Venezuela tensions, may actually be a larger quantum of supply of, the energy-related commodities. So, it might happen that once this is sorted out over the next 1 or 2 months, we're going to have a far better outlook than we possibly are at right now.
Manishi, good morning to you. This is Neeraj here, and I wonder if you believe that this is a good time to put money to work into India, or are the other emerging markets still giving you a better bang for the buck? Because the AI trade has still not unraveled as yet, right? There could be some time before it does, if it does, when it does. So is India a good spot, or are there other options available?
Thank you very much for that question, because it's something that almost everyone is grappling with. Not just people like us who have more direct connections with India, but even foreign institutional investors who turned bullish on India late last year. Over November and December, we saw quite a few upgrades. But some of them in my conversations are also having second thoughts about putting money into India. And, I think the primary reason behind that is not so much whether the AI trade would unravel, because the AI trade, the AI CapEx theme would remain strong for the time being at least, because there's a degree of fear of missing out among all the hyperscalers in this world. But I think the concerns are more fundamental as far as India is concerned. While we have had earnings estimates rising across the Asian universe, and we have had very sharp earnings estimate upgrades in Korea, China, even some of the ASEAN pockets, we have not seen that in India. In fact, out of the 170 to 175 market sector combinations that you have in Asia, about 40 are now showing strong upward inflection. But there are no such sectors from India. So that is concern number one. And the second concern is obviously the currency. That may assuage to some extent if the trade deal is signed, and therefore if the trade deficit, kind of narrows down a little more. But that's something we have to, kind of wait and see, because this news flow about this trade deal has been coming and going for the last 4 to 5 months.
Right, Manishi, Sharad here. Good morning to you. The question is on the macros front. India's macros decently has been good. We have checked out most of the macro indicators, and even the CPI inflation which came in it wasn't much very high as well. Of course, the core CPI inflation was slight up, but net, the overall macro indicators still suggest that there is strength in the economy. What's your view on that, Manishi?
Right. Again, very interesting point, because India right now is in a situation where it is good macro, but very pedestrian micro. You have, in fact, I would actually be happy if inflation rises a bit, because this real GDP growth of about 8.2% is not really translating into high nominal GDP growth. And nominal GDP growth is more important as far as corporate revenues and corporate earnings are concerned. So if the fiscal stimulus of last year is able to generate some inflation, maybe to the tune of 2.5 to 3%, then nominal GDP growth would go back into double digits. And that's actually a very good outcome for Indian corporate revenue and corporate earnings. So, I think, this connection between, a decent macro and, kind of a pedestrian micro, if you look at corporate earnings growth, in fiscal 26 and beyond, that is something that most foreign institutional investors and even domestic investors are waiting for. So, I think this good macro gives some kind of a, what should I say, some kind of a safety net to the investors. India has been relatively safe, relatively stable. Volatility has been low. But to have the next round of, significant appreciation, we need to have corporate earnings coming back.
Okay, so lots of factors to watch out for from the domestic perspective as well. But thank you, Manishi, so much for joining us on the show. Always a pleasure to speak to you as well.